Welcome to Indianomics. Foreign banks like Sumitomo Bank of Japan and NBD of Emirates want to own larger stakes in Indian banks. But the laws are not exactly welcoming because the Banking Regulation Act says no entity, Indian or foreign, can have more than 26% voting rights in a private bank. Now, it is tough for a Sumitomo Bank to convince their shareholders back home that they have 50% stake in, say, a Yes Bank, but only 26% voting rights. That explains why even the IDBI sale is taking so long. Separately, in PSU banks, FPIs, now I'm not talking foreign banks, FPIs, foreign funds, can own only 20%. But there is no such a cap for private banks. FPIs can own up to 50-74%. So the weightage of PSU banks like SBI and BOB in, say, the MSCI and the FTSE Emerging Market Index suffers. Does this cap need to go? For both these very important questions, I'm joined by former policymakers, actually two former Reserve Bank deputy governors, Mr. Anand Sinha and Mr. S.S. Mundra. I'm also joined by a banking expert, Harsh Vardhan, senior advisor at Bain Co. Gentlemen, thank you very much indeed for your time. Mr. Sinha, let me start with the more easy rule first. This 20% cap for FPIs in PSU banks, is that even needed right now? Since, you know, can that rule be just dropped?
Well, you see, we have to see why there is a cap. Now, government has to have a minimum of 51% shareholding in a public sector banks. So for other shareholders, you have 49% available. Now, the cap of 20% for foreign investors means that in the non-government space, they can go up to 40% of shares. Balance 60% is there for the domestic investors. So this can be modulated. I mean, one can even think of a very market-based situation where you remove the cap altogether and live with the possibility that the entire 49% is taken over by foreign investors. So that is one scenario which can be thought of over a period of time. But I would say that there should be, you can tilt the balance in favor of foreign investors to a certain extent, but not crowd out the domestic investors. That is how I would look at.
Okay.
So maybe you raise 20 to 25 to 30, but I won't think we are prepared to create a situation where domestic investors can be completely crowded out.
Okay. No, Mr. Mundra, let us look at it more from a stock market angle. I mean, practically, do you think any foreign fund or even set of funds will want 49% when you know that the government of India is going to call the tune in these PSU banks? Why should we even assume that a bunch of foreign funds will cartelize and try to buy 49%? The problem is because of this rule, and I'll put up a table for you which IIFL alternate desk has put out. Because of this, the weightage of SBI and BOB is less. It's a qualitative rule which lessens their weight in the MSCI, and they don't get enough foreign funds, even from passive funds. So, Mr. Mundra, your take. Can this rule be dropped? It's not serving any purpose.
Okay. Lata, there are, I think, to my mind, there are 2-3 angles to it. One, as Mr. Sinha has rightly pointed out, from any, nation's perspective, government's perspective, it would not be a great idea to completely crowd out the domestic investors. They have to have a say and pie in the public sector banking space. That is one point. The second point is the point which you mentioned, but tell me today, despite the government ownership, despite the government calling the shot, whether public bank performance is found wanting in any way. In fact, if you look at the recent history, I think they are performing better than their counterparts in the private sector banks. So that's the second point. The third point is, yes, from the perspective of the market capitalization of the bank, it will be a booster if the foreign investors can have a larger share. and the ultimately beneficiary for that would be the government. But looking to the recent history and where we are today, I don't think government is in a hurry to cash out on that portion. So to and beyond the economics and the logic of it, I think there is a political part to it, there is a sentimental part to it, and ultimately, even if you want to do away with 20%, it would need an amendment in the Banking Regulation Act.
Okay.
So while the argument is tilted on both sides, I agree there is a room. Room is not that from 20% you go up to the 49%. There could be a midway, but yes, that would need a political preparedness. That is how I look at it.
Okay, two things, sir. I am not accusing banks of performance at all. But what I'm saying is the presence of this cap, it is a qualitative rule in MSCI. Wherever there are such caps, since there can be a future restriction on the floating stock, the MSCI automatically gives it a lower weight. I will put up that table again for the benefit of our viewers. See, 20% is allowed. The maximum is 11% stake that foreigners have in SBI. In BOB, it is like some 5%. In PNB and other banks, it is in low single digits. It's not as if people are crowding even to the 20%. They will come when they feel like. So the point is, SBI, for instance, could have easily got $1.4 billion more of passive funds. They raised a QIP now. You know, instead of raising it at probably 800 rupees, they could have raised it at 900 rupees if this cap was not there. So, Mr. Harsh Vardhan, from a purely market point of view, since no purpose seems to be solved by this existence, can't we quietly drop it?
Lata, totally agree with you. This is a vestige of the nationalization era. It's old, more than 50 years old. And here there are several reasons, Lata. One is, if you look at a long-term view, you know, we say that our current banking credit to GDP hovers around mid-50s, and we want to take it to 130% as the part of that overall Viksit Bharat. I mean, our banking capital have to go to 50 trillion plus. If you just back of the envelope, where is this capital going to come from? And a lot of that will have to go into PSU banks. Otherwise, it creates a fiscal drag on the government. Every time these banks have to raise, and even if there is no NPA episode, even if the normal course of business they have to raise capital, the government has to put out 70, 80%, whatever stake it holds. So I think you need access to deeper capital pools for the banking sector as a whole. And remember, this 26% threshold comes out of Companies Act, because after that you become significant minority. Public sector banks are not under Companies Act. Government is hugely privileged. It has 51% ownership, has entire governance with it. So I don't know where the hesitancy come. My firm view is that we should allow it to go to 49%. Government will continue to own 51%. And look, I don't buy this crowding out argument. Look at the sectors where 100% is allowed. The nifty ownership of foreigners has gone down. So I don't see that to be an issue that should come in the way of allowing access of capital. And remember, now our regulatory capacity has dramatically increased. There are many instruments RBI has to deal with any governance issues that might come up with higher ownership.
Yeah.
By the way, even at 49, that 5%, 10% single ownership threshold will apply.
Yes.
It's not as if somebody is going to run away with 30% stake.
Fair point.
And in case of PSU Bank, the voting cap is 1%, not 26%. So I'm saying, given all of this, I just don't know why the hesitancy should be.
Okay. Well, fair point. Actually, I'm in agreement with Mr. Mundra that the government has that much political capital, and this may be the smallest reason why they have to expend it. They may want to expend it for other reasons. And the other point being that, you know, we may say that if you raise the cap, we will get more capital. Precisely when you want the capital, when we were going through the asset quality review, that is when the FIIs will not come. They will come when you least want them, you know, when anyway the capital markets are friendly. But that's another point. I would very strongly vote with Mr. Harsh Vardhan on the issue that this is a vestige of a previous era and can be quietly dropped without making too much noise. But Mr. Sinha, you know, the more important question is not really public sector banks. This became important only because of SBI's QIP. But otherwise, it is in the private sector banks that one single foreign bank, and now I want to make this very clear to our viewers, we are not talking FPIs as a category, we are talking about one single private bank wanting to own, foreign bank wanting to own a larger stake in an Indian private sector bank. Mr. Sinha, do you think the time has come to remove this 26% cap on voting rights if it is a widely held institution. You don't remove it for, a single individual, a promoter entity. But if it is a Citibank, if it is a Sumitomo Bank, they're anyway widely held. Should we start this debate at least that this 26% cap needs to go?
So let me make two basic points and then I'll come to this question. The reason why there is a cap on voting rights, which alternately you could do by putting a cap on shareholding and having a one-to-one correspondence between voting rights and shareholding, is from the perspective that we in India have so far stuck to the point that the ownership and control should be diversified. It should not be too much concentrated in one entity. So that is one. The second thing is that it is an accepted principle and it is documented in RBI circulars that we do not want the Indian banking system to be dominated by the foreign banking system. And the current metric is about 20% of capital and reserves can be held by the WOS and branches. So this is the scenario. Now, the second one has come out of the experience of global financial crisis. And this is not something which only India practices, which others also practice. Now, coming to your specific question, you see, there was a time when there was a cap of 10% for promoters and for everybody else. They were all on par, and even the voting right was capped at 10%. Then it was raised to 15% for promoters. That is, the idea was to create a better status for the promoter compared to non-promoters. And now it has been raised even to 26%. So that is the idea. But there could be situations where you may have to allow more than 26% shareholding. Supposing a bank is in distress and a foreign bank wants to take over. So that is a situation which is a perfect situation for allowing more than 26% shareholding, but the cap on voting remains at 26% for the reasons which I explained.
Yes.
I would agree that the cap should be operated on shareholding limits,
Okay.
rather than through a disconnect between voting power and shareholding.
Okay.
Now look at subsidiary,
Okay.
a foreign bank subsidiary. Now there is no equivalent for Indian banks because in India, a bank cannot have a banking subsidiary. So this is something very exclusive to foreign banks.
Yeah.
Now foreign banks, we allow them 100% ownership. Now here, the voting limit has no meaning at
No
all.
meaning.
No meaning. It is, in a way, you can say it is 100% voting rights.
So,
Now, the moment
Sinha, Mr. Sinha, actually, we are running out of time. We have to take a commercial break. We will continue the conversation after the break. But I suspect on this issue as well, Mr. Mundra's former point that political capital of the government is limited, and will they use it to remove the voting rights cap of 26%, that too to help a foreign bank, looks a very remote possibility. But it is worth debating whether we have to remove that cap because India is in a growing growth path and we will need foreign capital sooner or later. Those questions after the break. Back in a minute. Welcome back to Indianomics. We are in conversation with two former deputy governors, Anand Sinha and S.S. Mundra, and the banking expert from Bain Company, Mr. Harsh Vardhan. We've been discussing whether a foreign bank should be allowed to have larger voting rights in an Indian bank. They're allowed to own any amount of stake, but voting rights for any entity is capped at 26%, foreign or Indian entity. And we are discussing whether that cap needs to be removed. Mr. Sinha, of course, made a very strong point why it shouldn't be removed, because we want widely held board ownership, to ensure that no one entity or person has too much of a command, too much of an authority over people's money, over depositors. But Mr. Mundra, one entity is not the same as an Indian promoter. These are widely held companies, like we just discussed, a Sumitomo Bank or an NBD from Emirates. The second point that Mr. Sinha made is that we had a historical bias against why should we give away our market simply to foreign banks? We should not allow them to swamp us. But now Indian banks, both private and public, are really large entities. Should we really be worried that one NBD owning IDBI or RBL is really going to swamp us?
Okay, valid point, Lata, and I think Mr. Sinha also very well articulated what is the underlying philosophy. But let me bring a different perspective to it. See, you can't think only from the angle of foreign banks. If you have to look at these rules, it has to be looked into the totality. We should also look at the Indian entities, then Indian corporate houses. Now, you see, what if there is a cap for the promoter of a company with 26%, and if we are advocating that there should not be any cap for the foreign banks, or even if it goes up to 26%, really question remains then who is the promoter? And with having the equal situation on both the entities, should a promoter should still be held, responsible for something more than all the other shareholders? So that is one point. Second, coming to your point, this so-called widely held. See, when you have to frame a rule, you have to frame universal rule. Then at regulation or supervisory level, maybe you can look at the individual entities. But there are many jurisdictions and the advanced economies where there is, they are really not widely held. Even up to 50% is allowed to be a single entity. Now, if that is the ownership of the parent bank, and by translation they come to Indian bank, I think the whole idea about the widely held thing goes away. So then look at the situation. If something happens there after allowing this, if the ownership of that particular bank undergoes a very radical change in their parent country, it is not in the control of then Indian regulator. So whereas if you ring fence it, it is in the control of Indian regulator. So that is the another point. You mentioned about the Citibank. Not long back in history, Citibank was not widely held. It was held practically by the US government. Okay. So I think, Lata, it has to be looked into totality. It cannot be only looked from the prism of the foreign bank. Yes, then maybe some room may emerge that from present 15%, there could be a room to go to a certain extent. But again, keep in mind who will be the promoter and how you treat the promoter vis-a-vis other investors in the entity.
Fair enough. I think Mr. Sinha and Mr. Mundra are making very, very strong points. And my sense is that the government is convinced of the point of the two of you. Because even though they have taken about 6 years to divest IDBI Bank, they have not relaxed this rule. Though I'm sure bank after bank like NBD, etc., have been demanding this. Why should we take 50% and get 26% voting rights? And why should we take 26% when we can't call the tune in the bank? These are the questions that foreigners raise. Mr. Harsh Vardhan, is there a golden mean? Or should we continue to deny ourselves the capital that foreign banks may bring when we are in need of that?
Yeah, I mean, as a stock market person, Radha, you would know that the first rule of capital is that you raise it when it's available, not when you need it. And my view that, yes, there is a golden mean. Here is what RBI can do. They say we'll allow voting rights in proportion to shareholding, but carve out a set of decisions on which the approval will be needed or where the voting rights will be limited. Let's say CEO, all those issues that are relevant to governance, CEO appointment, etc., etc. If those are the areas of concern, then it can be very easily done. And that would, I think, be enough incentive for the foreigners to take higher stake. There is another irony, Lata, you must note, which I always find amusing. There are foreign banks that operate as branches in India, right? They build very large balance sheet, larger than many Indian banks, and yet have no real board oversight in India. They have advisory board, they don't have board, they don't have statutory boards. So on the one hand, we allow that where capital is completely fungible, it can go in and come out very easily under the branch setup. And in the digital age, branching and all doesn't matter all that much to build business. And on the other hand, we have all these restrictions. Finally, Lata, if you allow me one more, if the government has limited capital, it has a very simple fix. Repeal the Nationalization Act and put all the public sector bank under Companies Act. So all the private bank rules will apply to them. Problem solved.
Yeah. No, I think that's a great point, sir. I think it was in 2002 that Dr. Y.V. Reddy, then Deputy Governor, had made this point that really we have outlived the need for this Banking Companies Act, which was in place because of nationalization, that they should be all brought under Companies Act for a whole host of reasons. You know, for the presence of independent directors and for the more eventual easy divestment of the 51% stake of the government. But Mr. Sinha, you have the last word, sir. If this law has to be tweaked, I'm not very sure the government is going to buy this rule that for certain things 50% or higher voting right is allowed, but not for certain things. It's also messy to communicate. Is there a golden mean, or do you think for larger public good reasons the 26% voting cap should continue?
Actually, Lata, I was not able to complete what I was
Sure.
saying. What I said was that for a 100% owned subsidiary, voting right has no meaning. The moment it becomes 99%, 26% kicks in. Now, this is not logical. Therefore, I would advocate that over a period of time, we should do away with a cap on voting right and link it to the shareholding in 1-to-1 proportion. And then how do you ensure that the people who are having higher shareholding, in fact, in all other countries that I have seen where there is no cap on voting right, but there are thresholds of shareholding where prior approval is required. So we can control it from that perspective rather than from the voting right perspective, because I understand that somebody putting in money and not having the equivalent voting right would not be very comfortable. I also wanted to say, which Mr. Mundra has clarified, there cannot and should not be a separate rule for foreign banks. If we do away with voting right cap, it has to be across the board. Why should we discriminate against Indian banks or Indian investors? So, and you see, the regulatory space moves slowly, no doubt, but it's a dynamic one. If you look at the last 10 years, so much has changed. From 10%, it has gone to 26%. So as the situation evolves, there would certainly be changes. And I would personally vote for the change which I just now talked about.
Yeah, of linking the voting rights to the shareholding. And perhaps with other rules not allowing, too much of ownership, keep the ownership widely held. But I think the clincher would be to bring banks under the Companies Act. That would perhaps remove a lot of anomalies automatically without the government having to expend political capital. Let's see if we can convince the powers that be. Unfortunately, out of time, we'll continue this conversation when it once again crops up in public memory. Mr. Mundra, Mr. Harsh Vardhan and Mr. Sinha, thank you very much indeed for your time. We wrap up on Indianomics. Thanks for watching.